the get to the next worksheet for the 30th. Which acquisition equity of the subsidiary, consisting of two sections. First of all, we want to show the assets and the liabilities of the subsidiary at fair value. So where the carrying amount of the assets and liabilities are not equal to the fair value, we need fair value adjustments resulting in the BCVR entries. In this question, we've got a parent company that doesn't own 100% of the shares, so there's other shareholders making up the NCI. So the BCVR that we create as a result of the fair value adjustments forms part of the equity of the subsidiary, and we need to share that between the parent and the NCIs. Okay, the second part relating to the at acquisition equity of the subsidiary looks at the parent company's share of that at acquisition equity of the subsidiary. Now, you know by now that the purpose of these entries is to eliminate the parent's share of the subsidiary equity. We eliminate that against the investment in the subsidiary that's included in the parent company's accounting records, in order not to overstate the group assets and liabilities. Now, the elimination entries regarding the parent share of the at acquisition equity of the subsidiary started with what I refer to as a basis journal, which is eliminating the parent's share of the at acquisition equity of the subsidiary on the acquisition date. So if you had to prepare a consolidation worksheet straight after the acquisition was made, later on we need to consider any consolidation adjustments that are made that relates to pre-acquisition equity, because that's going to affect this basis journal. So we'll see that in subsequent consolidation worksheets, this basis journal is adjusted for entries in later financial periods that relates to pre-acquisition equity. So what I want to highlight therefore is that with regards to the consolidation adjustments that affect the parent share of the equity, we normally do the split in terms of whether it is pre-acquisition equity, in which case it will affect this basis journal, or whether it's post-acquisition equity where we deal with it in the current financial year, or if it's between acquisition date and the beginning of the current financial year, the adjustment will be against the opening retained earnings. This is just important to take note of, because when we look at the NCI calculation in the following slide, you'll see that with regards to the NCI, we don't do the split in terms of pre-acquisition and post-acquisition equity, but there we actually do it in 3 steps, and I don't want to spend too much time on it in this video clip. So just take note of the fact that for the consolidation adjustments affecting the parent share of the subsidiary equity, we split we categorize the adjustments whether it affects pre-acquisition equity or post-acquisition equity. And as I mentioned, the pre-acquisition equity is going to affect the the at acquisition equity elimination entries that we're going to cover in this video clip. Okay, so let's move on and then have a look at the at acquisition equity entries that we are going to include in our consolidation worksheet. Now, this first entry is not part of the solution, but that is what I referred to this first section as the basis pre-acquisition entry. So that is the initial entry that would be included in the consolidation worksheet on acquisition date to eliminate the parent share in the subsidiary's equity. And we eliminate that against the investment in the subsidiary. Now, this account would have forms part of the accounting records of the parent company, investment in subsidiary. So we eliminate that investment and replace it in the consolidated results with the fair values of the assets and the liabilities acquired. Now take a note of the values included in this entry. The questions so far included 100% of the subsidiary's equity on acquisition date. So the retained earnings, share capital will normally be there. In this case, there were an asset revaluation surplus. There might be other equity balances like a general reserve perhaps. Then the business combination valuation reserve that was created in the previous step where we adjusted the carrying amounts of identifiable assets and liabilities to the fair value where those values differed. But take note here that we don't bring in the full BCVR. In these entries, we only work with the parent share of the subsidiary's equity. So in this question, it would be 80% of the full BCVR. And then we've got here the unrecorded goodwill that relates to the control premium. So that is the portion of the unrecorded goodwill that relates solely to the parent. And we covered the calculation of that in the video clip on the acquisition analysis. But that is the portion of the goodwill that relates to that extra little bit that the parent company paid for gaining control of the subsidiary. An alternative approach is to include the portion of the unrecorded goodwill that relates to the business combination, so that core goodwill that I referred to in that calculation. You can include it here as an item on its own, but in this suggested solution, it formed part of the BCVR. So you can decide which approach you want to follow. But the solution goes with the approach adopted in the textbook. Okay, at the 1st of July 2011, there would also have been an adjustment for the dividend payable and dividend receivable, so eliminating that intercompany balances that were due to the parent company and receivable by the parent company for 80% of the dividend payable. So remember then in these entries to work only with the parent share of the balances. Okay, but as I mentioned, this wasn't part of the solution. What we want in the solution is the next section, but you need this basis entry to use as a starting point in order to be able to draw up the entries at the current financial year end. Now, the pre-acquisition entries in the current year consist first of all of the elimination of the parent share of the subsidiary's equity at acquisition date with subsequent adjustments to that pre-acquisition equity that occurred since acquisition date until the beginning of the current financial year. And then any adjustments resulting or that occurred in the current year is shown as separate journal entries for that year. In the following year, these entries will be incorporated in this the basis journal that we pause. So we have to consider for that first part, from this date, what has changed until basically the beginning of the current financial year. Now, with regards to our retained earnings and the BCVR, there were first of all inventory that was sold in the first year after the business acquisition. So you know then that that inventory that was revalued to fair value on acquisition date, when that inventory is sold, the BCVR relating to that asset is transferred to retained earnings. So the retained earnings at acquisition was $50,000. The inventory, the BCVR relating to the inventory was 3.5. So transferred from the BCVR to the retained earnings. And because we only work with the parent section or portion in this journal entry, we calculate 80% of that balance to get to the 42,800. Share capital stays the same, so it's 80% of the 200,000. The BCVR has been adjusted for the inventory that has been sold, and we calculate 80% of that value to get to the 25,200. So it basically consists of the machinery, which is the 8,400 plus the where's those entries now? The 2,100. That's the machinery that was sold during the year, but we deal with that transfer separately, plus the 3,500 of the vehicles. So you can see the inventory is not included in that. So 8,400 plus 2, 10.5 plus 3,000. It's 14,000. Sorry, no, I forgot about the goodwill. 17.5. Just do that calc again. 10.5 plus 3,500 times 80% gives the 25,200. Asset revaluation and the goodwill control premium. Okay. So in the current year, that machinery that was sold, it is transferred the BCVR from BCVR to retained earnings. Okay, so once again, although this entry appears to be the long way around, remember to view it in terms of this basis entry. So we're going to reduce the BCVR with 1,680, which is the parent share after 2,100 times 80%, and we're going to increase the retained earnings by 1,680. The other item that affected our pre-acquisition equity is the asset revaluation surplus. In the question, they told us in the current year the subsidiary transferred 10,000 from the asset revaluation that was on hand on acquisition date to retained earnings. So we transfer it from the asset revaluation surplus to retained earnings. Now, it seems to be a bit confusing, but remember the transfer from asset revaluation surplus is just the reference in the retained earnings account so that we can trace where that comes from. Okay, so it was $10,000 that was transferred from the asset revaluation surplus to retained earnings, but in this entry we only deal with the parent share of the 10,000, so 80% of the 10,000. Don't forget about the other 20%, as well as in this case the other 20%. Both of those we'll deal with in the NCI calculation. Okay, if you look at this entry as well, similar to the bottom one, it seems to be the wrong way around, but remember to view it in terms of this original entry. So we reduce our asset revaluation surplus and we increase our retained earnings. Okay, so in the following year, remember then that these entries will be incorporated in this original entry. Okay, so that gets rid of the parent share of the subsidiary's equity. So what is left then is, if you just think of what happens in the consolidation, we'll have retained earnings, we'll have share capital, we'll have asset revaluation reserve, with balances flowing through from the parent set of financial statements, balances flowing through from the subsidiaries' accounting records, and that gives us our combined results. We then pass our pre-acquisition equity entries, which gets rid of 80% of the subsidiaries' equity, if this makes sense now, and 80% of the subsidiaries' share capital, and 80% of the subsidiaries' asset revaluation reserve. So we still sit then with a balance of 20% of the subsidiaries' retained earnings, share capital, and other equity accounts. Now, we got rid of the parent share. What we're going to do now in the following video clips is to calculate the NCI share of that. And what we're going to do is we're going to extract it from here and disclose it separately as NCI in the combined, or not in the combined, in the consolidated financial statements. So see the difference of the consolidation entries relating to the parent entry, where we eliminate their share, versus the adjustments that we pass for NCI, where we extract their share and disclose it separately. Okay, so that's what we'll cover in the next video clip.